Let's be real. Picking stocks can feel, well, completely overwhelming, right? Almost like you're searching for a needle in a haystack. But what if there was a simple, step-by-step process to find the winners? Well, that's exactly what we're going to break down today. We're going to demystify the whole world of stock research for beginners. I know what you're thinking. That sounds a little weird, right? But honestly, it's a brilliant way to think about investing. See, when you buy a share, you're not just buying a ticker symbol on a screen. You're actually becoming a part owner of that business. You're entering into a partnership. And just like any good partnership, you want it to be successful and you want it to last for a long, long time. So, just like in dating, you need a strategy before you just start swiping right on every stock that pops up. You have to ask yourself, are you looking for a quick trade? Or are you in this for a long-term commitment? Because believe me, your approach is going to make all the difference. Now, there are really two main ways to go about this. On one side, you have the day trader. This person uses what's called technical analysis. They're looking at charts and patterns, making short-term bets on which way the price will move. It's super high risk. Some people even call them glorified gamblers. And then on the other side, you have the long-term partner. This approach uses fundamental analysis. You're basically acting like a detective, digging deep into a company's health, looking for a solid relationship that could last for years. And when I say that short-term strategy is risky, I am not kidding. According to The Motley Fool, over 95% of day traders actually lose money. That is a huge failure rate. And that's exactly why, for this explainer, we're going to focus on that long-term fundamental approach, the one that's about building wealth that actually lasts. So you've chosen your long-term strategy. Great. Now it's time to check their profile. I mean, think about it. You wouldn't commit to a serious date without seeing their pictures and reading their bio, right? Well, you shouldn't commit to a stock without first checking its financial statements. The very first document you're going to look at is the balance sheet. The easiest way to think of this is as a snapshot. It tells you exactly what a company owns and what it owes at one single specific moment in time. And to make this super easy to understand, let's use the cookie jar analogy. Think of a company's finances as a big cookie jar. The cookies right on top, the ones you can grab immediately, those are your current assets, things like cash. The cookies that are deeper down, a little harder to get to, those are long-term assets, like buildings and big equipment. And the current liabilities? Well, those are the cookies you've already promised to your friends. They're the debts that have to be paid back soon. So, the big question is, can the company cover the cookies it owes? A really simple calculation can tell us. We just divide the total current assets by the total current liabilities. For a company like Coca-Cola, that number comes out to 1.13. So what does that 1.13 actually mean? It's simple. For every $1 of debt they have to pay back soon, they have $1.13 in easy-to-access assets to cover it. A number above 1 is a very strong sign that they can handle their bills. That's a green flag. Okay, let's move on to the next document. This is the income statement. If the balance sheet was a snapshot, think of the income statement as the company's report card. It shows how well they performed over a certain period of time. Did they actually make money? And how much did they have to spend to make it? A really key number to look for here is the operating profit margin. This tells you how much profit a company makes from its main business for every dollar of revenue that comes in. For Coca-Cola, that number is a very healthy 25.7%. But is 25.7% good? I mean, it's just a number without context. Well, here's a general rule of thumb for you. A 5% margin is considered low, 10% is pretty healthy, and anything over 20% is considered high. So yeah, Coca-Cola's margin is exceptionally strong, which is another great sign for an investor. All right, finally, there's the cash flow statement. Let's be honest here. Back to our dating analogy. In a relationship, you don't want someone who's terrible with money, right? It just leads to headaches later on. The same is true for a company. This statement shows you exactly how cash is moving in and out of the business. And here's something you might not expect. Not all negative numbers are bad. Cash from operating activities, their main business, that should definitely be a positive number. But a negative number for investing activities can actually be a great sign. It often means they're reinvesting in their own future and growth. The place to be careful is financing activities, where you just want to watch out for too much borrowing. Okay, so the numbers look good, the background check is solid, but we've all met someone who seems absolutely perfect on paper, and then you meet them in person and there's just no spark. A company can be the exact same. The numbers don't tell the whole story. You need to do a vibe check. This is what we call qualitative analysis, looking at the things that a spreadsheet just can't capture. Like, how strong is their brand? Do people know it and trust it? Who's in charge? And maybe most important of all, what is their secret sauce? What's their unique competitive advantage? And that leadership point is so critical. Just look at this example from 2016. A single tweet from Donald Trump about the F-35 program sent Lockheed Martin's stock into a total nosedive, wiping out almost $4 billion in market value in a single day. The person at the helm really, really matters. But hey, even great leadership can't prevent every single storm. And just like any relationship, investing has its rough patches. So imagine you hear a nasty rumor about your partner. Do you panic and break up on the spot? Or do you rely on the solid foundation you've built together? That same kind of emotional discipline is what you need in investing. So, what really happens when the headlines are just full of fear and bad news? Well, way too often people react emotionally. They rush to sell, which, honestly, usually just makes the situation even worse. This is a perfect illustration of that point. When the Cambridge Analytica scandal broke, Facebook's stock plummeted. People who panic sold lost a lot of money. But for those long-term investors who had done their research and still believed in the company's fundamentals, that 18% drop was just a blip on the radar. The stock didn't just recover, it went on to gain over 200% from that low. So, you've found a company you believe in, but you don't want to just settle down with the very first person you go on a date with, right? It's really important to explore your options and build a whole portfolio, not just bet everything on a single stock. And to build a strong portfolio, it really helps to understand the two main types of stocks. You have value stocks, which are usually big, stable companies like Procter & Gamble or Berkshire Hathaway. They tend to be a little cheaper and often pay dividends. Then you have growth stocks like Amazon or Tesla. They're all about rapid growth, so they reinvest all their earnings to get bigger faster. A healthy portfolio usually has a nice mix of both. And the most crucial point here is diversification. A good rule of thumb is to not have more than 20% of your money in any single sector of the economy. Spreading your investments across technology, financials, consumer goods, and more, that's what helps protect you if one part of the market has a really bad year. So after all is said and done, after looking at the strategy, the financials, the vibe, and how it fits into your broader life plan, it all comes down to this one simple question. Is this a company you truly believe in? Is this a company you want to partner with for the long haul? The answer to that? Well, that's the real heart of smart investing.